Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a guy I had on, and I thought, he'll be okay. I'm just going to have him on to fill a little time. Wow, he was a huge hit. His name is Rob Kirby of Kirby Analytics. Rob Kirby, thank you for joining us again on USA Watchdog.
Pleasure to be with you, Greg.
Now, you have KirbyAnalytics.com. It's a subscription service. You work for big-name clients around the world, helping them. One of the things you do is you help secure bullion. You also have been really right on about the economy, very insightful about what's been going on in the economy. And I want to just kind of start with last week's taper. I was a little surprised. I mean, we didn't have good numbers in housing. You know, they knew the numbers a day or two before they came out. We didn't have good numbers in unemployment. It spiked up. But still, they tapered. We're back down to $65 billion a month, which is supposed to be some woo-hoo-woo. I mean, we're still pumping out $65 billion a month, $30 billion for the banks, their mortgage-backed securities, their toxic debt, and $35 billion for treasury bonds. And I thought rates would shoot up. What happened?
Well, Greg, we were told last year on the threat of taper, the 10-year bond yield went from basically 2% to just over 3%. 10-year bond yield crested at 3.05 in late December 2013. Late December 2013 is also when taper was actually announced. And since then, we've had an additional or a second round of taper announced. And so since taper has actually been announced, the 10-year bond yield has gone from a high of 3.05 to where it is currently this morning at 2.66. So the threat of taper made rates go up. Actual taper has made the 10-year bond drop 40 basis points in less than a month. So the notion that taper had anything to do with interest rates or the threat of interest rates going higher seems to be, a non-story. So from there, we got to figure out, well, then what was taper really all about? Well, taper, when it was first instituted, had the Federal Reserve buying $85 billion worth of bonds per month. The bonds that the Fed was buying was split evenly between mortgage bonds and government securities. Now, so roughly every month the Fed was buying $40 billion worth of mortgage bonds. So now let's talk about what the root of the financial crisis really was. The financial crisis began in 2007, and it was touched off after Bear Stearns blew up in the spring of 2007. The reason Bear Stearns blew up was due to toxic mortgage bonds that were rated AAA that failed, and they were worthless. So my thesis about taper is that the banks in the U.S. had mortgage bonds on their books, probably to the tune of close to $1 trillion, which were unsaleable, that they could not sell to anyone, and it was dead money, and they had to write them off somehow. The problem with writing off close to $1 trillion worth of mortgage bonds that were held in all the U.S. banks is that kind of money is basically as much or maybe even a little more than the total market capitalization of the U.S. banking industry. So they had to figure out a way that they could get those mortgage bonds off the books of the banks and silo them somewhere without basically admitting that the U.S. banking system was insolvent. So they invented this tale of liquidity and a taper and how it was going to be good for everyone and how it was going to help them. Oh yeah, and keep rates down. And the reality was they had to extricate these toxic mortgage bonds off the books of the banks. And, for the most part, with them now tapering, their taper, we can almost say mission accomplished. They've taken these mortgage bonds off the books of the banks. They're siloed right now on the balance sheet of the Federal Reserve. And what the Fed plans to do with them, I don't really know. And I don't have all the answers. But I think we can see empirically that this whole thing about taper had nothing to do with interest rates and keeping rates low, because now that they're actually tapering, rates have dropped. the threat of taper made rates go up. This whole notion is that the Federal Reserve is trying, everything they tell us is a lie. Misdirection. These people, they preach that they're about transparency, but everything they do is misdirection and sleight of hand and a shell game. So they had to get the bonds, the mortgage bonds that weren't worth anything. They had to get them off the books of the banks. Otherwise, the banks were going to be basically incapacitated in terms of ever being able to make new loans, much like the Japanese banks were throughout the decade of the 80s and the 90s. When they left toxic assets on their balance sheets, it impeded the Japanese banks' ability to make loans. Well, the same thing was going to occur in the U.S., and they had to get the bonds off the books of the banks, and this is what taper is really all about.
That they've gotten most of the junk off the books already, and now they're starting to wind it down because they've removed most of it, and they don't need to remove it at the same pace because it's dwindling off the bank's books, correct?
Yes.
Does that mean that if the Fed gobbled up all this worthless paper and printed Federal Reserve notes for, trillions of dollars, doesn't that mean the Fed is insolvent? Aren't they insolvent? Didn't they eat a poison pill?
Well, there's a lot of people that would say that due to the size of the Fed's balance sheet, there really is questions about their solvency going forward. Greg, that's a very good question. Usually when a central bank expands their balance sheet the way the Federal Reserve has, usually you see what manifests out of that usually is a rapid increase in the money supply, and usually what you see is a pickup in the velocity of money, and you usually see, or typically you might see something approaching like a hyperinflation or the seeds of a hyperinflation manifesting themselves. That hasn't happened yet. And, they've been able to keep all this money printing contained basically to the banks. The banks haven't been extending credit, haven't been lending, and, but due to the size of the Fed's balance sheet, that represents basically potential. And what it is, I call it stored up kinetic energy, but it's potential for a rapid increase in money supply. And because what it is in its purest form, it's monetary debasement. And when you have that much monetary debasement, you're going to see nominal prices increase. And it's just a matter of how long before that works through the system. Well, it will occur.
Well, according to John Williams at shadowstats.com, who I love, I know you like him too. A lot of people love him because he does real numbers. He computes the numbers the way they were before all the, geometric smoothing and all the hedonic measuring and all the junk. And he says, listen, if you did inflation the way the Bureau of Labor Statistics did it in 1980 or earlier, you'd have about a 9% inflation rate. So we're not escaping inflation. We still have inflation. They're just lying about it. As you say, everything we have is every number that comes out, unemployment, inflation, GDP, just seems like one big fat lie.
Yeah. Well, you see, Greg, what we're witnessing and experiencing is basically it's a war between the keepers of the fiat system and foreigners who have lost faith in, due to recklessness on the part of regulators in America and their stewardship of the world's reserve currency. Foreigners have lost confidence in the U.S. dollar and have lost confidence, for the most part, I'd say, in fiat money. This is why all the emerging market countries, the Chinas, the Russias, the Asian countries, this is why they're all buying gold. And it's a refutation of the U.S. dollar as the world's reserve currency. And lo and behold, isn't it interesting that just as this physical gold problems have started to manifest themselves with people not being able to get the gold they want, Germany not being able to get their gold back, and the mainstream is even starting to talk about the difference between paper gold and physical gold, and there isn't enough physical gold. Isn't it interesting how we have had an emerging market currency crisis rear its head in the last 2 weeks, and the most adversely affected countries in this emerging market currency crisis are all countries that either are buying gold or facilitating other countries purchase and trade in gold. What we're experiencing, if you want to put an umbrella over everything we've talked about here so far, it's economic warfare. And it's basically Keynesian on one side versus people who are fed up with Keynesianism and are tending towards sound money on the other side. And the Keynesians do control the world's reserve currency, which is the American dollar right now. And the people that have lost faith in it are basically on the sound money side. And the Keynesians are pulling all the stops out to try and impair the sound money group, which are represented basically by the emerging market economies. They're trying to impede their ability to continue to buy more gold or to be on the line of wanting more gold. So this is what and interestingly, and to back that up, we know that back on October 31st, the that was October 31st of 2013, the Federal Reserve announced that they were going to be renewing their bilateral swap lines with the 5 major Western central banks, namely the Bank of Canada, the Bank of Japan, the ECB, the Bank of England, and the Swiss National Bank. It was announced that they were going to be renewing and making permanent their swap lines with those central banks. They announced it on the 31st of October. Nothing happened, Greg, for over 2 months. And then between January 15th and January 17th of this month, literally days before the news broke on the emerging market currency crisis, and the first speaking of that in public was a Bloomberg article referencing a problem with the Turkish lira. And Turkey is a country that's been facilitating massive amounts of gold trade in Asia and the Middle East. So we had this crisis develop literally 4 or 5 days after the Fed had renewed all of the Western central banks' swap lines. And I mean, this to me represents almost a smoking gun that the emerging market currency crisis has indeed been engineered, and it's part of this call it it's economic warfare. Let's just call it what it is.
This is why the Turks had to raise their interest rates to, I believe it's the Turkish lira, is that right? They had to raise their interest rates dramatically to defend their currency. And all of a sudden, we have the top central banker in India. They are also big on gold and silver. They're talking about how there's no cooperation between central banks. And also the Chinese, one of a former chief economist for the World Bank, came out and said that, the problems in the world are caused by the U.S. dollar. I'm paraphrasing. And we should get rid of the U.S. dollar as the reserve currency. I mean, those are fighting words for the U.S. I mean, the inflation that you're talking about that could be unleashed could be massive if more and more countries continue to shed the dollar, to shun it. Is that what you're talking about? How we can get this massive rise in inflation?
Absolutely, Greg, because the sound money group of countries, the anti-Keynesian people, they are engaged in an economic war with the Western dollar-based Keynesian people who've been printing all this money, and there's been a fracture where for many years the world more or less got along on an economic basis, or one side had so much more power over the rest that they could just inflict their will on people by brute force. The rise of the sounder money people and the importance of the Chinese economy and its contribution to world GDP has meant that they just can't be pushed under the way maybe they previously were. And the other thing is these people are also realizing how rotten to the core and corrupt the stewardship of the world's reserve currency has been under American tutelage. It's a disgrace what's really occurred here. It's a complete and utter travesty to humanity, and people now in other parts of the world are onto the game. And this, Greg, is also you see this manifested in the ongoing investigation of the German regulator BaFin, which is an adjunct to the Ministry of Finance in Germany. These people
about the gold, that the gold fixing, the gold price manipulation is worse than LIBOR, is what the Elke Koenig said, the top BaFin regulator. Worse than LIBOR.
Yeah. Well, my understanding surrounding the BaFin investigations, Greg, is that BaFin is quite likely investigating more than gold. I believe that they're also investigating interest rates, and I think there's a pretty big body of material that they're investigating, and they've been on the job for quite some time, and we'll in the end we're going to see where this all ends up. But, right now I think there should be a lot of people in very high places in the world of international finance that should be looking over their shoulder, because the world, I don't believe, is going to stand for the corruption and the fraud and the deceit that's occurred in our capital markets and is a mainstay of our capital markets today. It's unsustainable, and I don't believe it's going to be tolerated.
How does this inflation trickle down to the people on the main street? I go out and I feel like I'm like Neo, and I feel like I've taken the red pill and I am walking around in a blue pill world. I feel like nobody really knows what's going on. Everybody's tending to their kids and filling up their cars and doing whatever. And I see, I keep getting this future blast of closed stores, of gas lines, of high prices. Am I just have too much of a vivid imagination? How does this scenario play out where we have this high inflation, hyperinflation? How does it get out of the Federal Reserve and they actually lose control?
I mean, how does it? The evidence, Greg, I believe, is everywhere that they are maybe still. I mean, they still control the paper price of gold. They still control interest rates. They still control the equity markets. They still control foreign exchange rates. These things are all set arbitrarily, I've been saying for years. And, and evidence, I do believe, is starting to really hit people over the head that this has indeed been the case. And there are people in the world who don't like this. They don't like the idea that one country in the world can arbitrarily assign a zero rate of interest, to money. Zero interest rates trivialize labor. They trivialize effort. They trivialize, human contribution to things. It pillages the capital stock of countries where rates are at zero. When rates are at zero, nobody has any incentive to save money. And the capital stock comes from savings, not from consumption. Consumption destroys the capital stock. And when you have zero interest rates, there's no reason why anybody would ever save money. And, the fraud and the deceit of reporting inflation at less than 2% when it's really at 9%, it makes people want to spend money as opposed to save money. And as an evolved species on this planet, which, the other thing too, when you print infinite amounts of money, Greg, that represents demand. I mean, money is demand in fiat form. And, when you live on a finite planet with finite resources and you're increasing, printing money at an infinite rate, the two don't mix. It's not sustainable, and it doesn't look good for humanity going forward.
What's the trigger? I mean, you're describing a fuse, going into some sort of a bomb. I mean, the renowned Doug Casey said it's the bond bubble's the biggest ever, and it's looking for a pin. What's the trigger that you see that could touch off this inflation and destroy the standard of living? And does it happen when? This year? Next year? What's your prognosis?
Greg, the last time we talked, I said the Achilles heel of this whole mess is physical gold. And I'll say it again. The Achilles heel is physical gold, and the emerging market countries led by China, seconded probably by Russia, are demanding more and more physical gold. The Keynesian side of the equation, which is led by the United States or the Anglo-American banking complex, they are trying to supply the world with increasing amounts of promises of gold or paper gold, and these two things just don't gel together. And when it blows up is when the emerging market people who are demanding increasingly more and more physical gold, when their demands can't be met due to finite supply, that's when this thing blows up. And you know what? I reckon that comes sometime in the near future. Could very well be, it could be in a matter of weeks. It could be in a matter of months.
Why do you say that?
Well, because I say that because up until now, there's a great percentage of people and players in our capital markets who still accept paper representations of physical metal as the real thing. But the audience of people that realize that paper is paper and physical is physical, and are showing their case that they want and won't take paper and want the physical, that audience continues to grow, despite efforts to pound the price into the ground on a repeated basis like clockwork on the part of the Anglo-American banking complex. Their games are being shown to be the fraud that it really is. People are getting wise to what's going on, and it's getting to a point where every time they push the price down of gold by $20 in the space of 2 or 3 minutes, it tends to now, as opposed to making people move away from the product or away from gold as an investment, people tend to look for this now, and it's a cue to go and buy more physical metal. So, it's the old saying, the boy who cried wolf too many times, people start to ignore him. Well, when people use this paper tool to crash the price of gold, and they do it too many times, people get wise to it, and they use that as an excuse to buy more and more physical, which compounds the problem for the people doing the price rigging. And this is occurring, and it's becoming a bigger and bigger and bigger problem, for the people doing it. So, at some point, they will be overwhelmed by their own crookedness.
Well, listen,
it's a very sad comment.
It is a sad comment because no system. I've always said, long said, and I'm sure some economists have said this and put it in a paper, but I've long said no economy can grow under a backdrop of fraud. You have to have confidence in the system in order for the system to function efficiently and effectively. And what we have is a big bunch of market rigging, fraudulent price rigging. I mean, when you have countries and regulators, top regulators of countries the size of Germany, saying that the gold market is rigged worse than LIBOR, and your sources are telling you that, this is more than just gold they're looking into. They're looking into a lot. It just tells me that the whole system stinks globally. And people are running from it.
Yeah. And what that speaks to, Greg, and what it reeks of, is that, yes, a reset is coming. A reset is coming because there has to be one.
Christine Lagarde was talking about that at Davos, and it made me because they talk and shout at reset and risk is what she brought up, her 2 R's. She had another one about recovery. Oh, this is a wonderful recovery. I'm just, but reset and risk, and, the reset has to happen. The reconfiguration of the market just has to happen. I'm thinking, whoa, what is she talking about? You're talking about a reset in currencies, the dollar. I mean,
Oh, yes.
do you think the U.S. is actually going to say, okay, we're going to devalue our own currency to make this debt go away somewhat? We'll pay you back in dollars, but they're devalued dollars. Is that what the plan is going to be?
Well, I mean, what you're really saying, I think, Greg, is whether the U.S. is going to admit what they've been doing, or whether it's going to be forced upon them and forced into the open exactly what's been going on. I look at it a little bit metaphorically, Greg. What we're really discussing here is you've got an entity perched way up high on a balcony, and what's coming is there's going to be a great fall. So what we're really debating is whether the person's going to jump off the balcony or whether they're going to be thrown off the balcony. But any way you look at it, there's going to be a fall. And to a point, it's almost moot whether they jump or whether they're thrown. I mean, if I was a betting person, I'd almost start to bet now that the person's going to be thrown off the balcony. And that metaphorically, I think, will be the world community galvanizing and basically pushing the U.S. dollar off its perch.
Do you think that happens this year? You said soon.
I think it's likely that it'll happen this year, and it may happen sooner than that.
You know, I want to close in this, and I just think it's weird. I just want to bring up the now 3 bankers, one in Washington State, pretty high up financial people, bankers, shot himself in the head on alongside the road. Another guy, Deutsche Bank in UK, hung himself. This is all last week. And another guy threw himself off the 33rd floor of the J.P. Morgan building in London. You know, if you believe, the folks in Davos, Switzerland, Christine Lagarde, the head of the IMF, that, we have a recovery. I mean, wow, you mean things are going so great that all of a sudden we just want to kill ourselves? I don't get that. Do you think that may be a sign that the bankers are getting nervous, and maybe some people want to squeal, and maybe some people feel like, oh my gosh, I'm going to go to jail or whatever?
I think what you're saying is very likely accurate. Isn't it amazing how birds of a feather fly together and sometimes they fall together? The banking system, Greg, as we know it, I don't believe will be a workable model or the model of du jour going forward. And people who are invested in the status quo, who have insight and who have been engaged with the system and doing what the system has been doing, I think in reflection, they probably aren't too pleased with where things are and where things potentially are headed in the near term. And it could very well be that, people are just starting to say, it's checkout time. So, that's a sad situation. And, if what we've been talking about is indeed accurate, which I believe it is, I think you're going to probably be seeing a fair amount more of this. People having accidents, and people either committing suicide or being suicided. I think you're going to likely see more of this in the near future.
And one last thing I want to follow up on. Just because they've removed a lot of this junk out of the U.S. banking system, does that mean the banks are all solvent?
It means that the bank's balance sheets, at the conclusion of removing this toxic garbage from their balance sheets, may be in a position to actually engage in commercial lending again, but it doesn't mean that the nuclear waste has gone away. It just means that it's siloed somewhere else, and it still needs to be dealt with. And if there's ever any real transparency about the true nature of how much of it there is and where it rests, there's a very, very good chance it undermines the credibility of whoever is left, the bag holder, whoever's left holding it. And it'll be interesting to see how the Fed can ever move this material. moving hazardous waste, Greg, is fraught with danger to the people moving it, and it's also can be very, very lethal and dangerous to communities where it's being moved through. But disposal of it has been an age-old problem. Ask the people at Fukushima how difficult it is to deal with the problem of nuclear waste.
And one last thing, I want to bring up this about the derivative book. You brought up a really good point about how much pressure was being put on interest rates because of the derivatives, and we don't know what the fourth quarter, we'll find that out in March, but you were talking about $12 trillion in derivatives just put on in the last a few quarters, the second and third quarter of 2013. Is that one way they are pushing these rates down? And if that's the case, this huge derivative book of business, I mean, what, J.P. Morgan, Goldman Sachs, for example, has $100 billion or so in capital and, $40 trillion in derivatives, most of which are interest rate derivatives. Doesn't that represent a big problem to these big banks? Even though their mortgage-backed securities on one side are off, don't they still have some huge leverage in the derivative market that could sink them if rates spike?
Yeah, well, Greg, interest rates and control of interest rates has always been affected through interest rate swaps, not taper. The tool for controlling interest rates is interest rate swaps. And over the course of 2013, as rates were rising, the American banks, the size of their interest rate swap books began to vector up. And this basically created settlement demand for U.S. government bonds, which stemmed the rise in the 10-year bond, and I'm going to say, go out on a limb here and say it's actually now reversed the direction of interest rates. I believe interest rates are now going lower, and I do believe that with Janet Yellen now in charge of the Fed, Janet Yellen is the most dovish chairperson who has ever graced the halls of the Federal Reserve, and Janet Yellen has the tools to lower interest rates in the interest rate swap mechanism. I don't think for a minute she's going to hesitate to use it. And as she does, and the data will come out in the next couple of months when we see the March edition of the OCC's quarterly derivatives fact sheet. The proof will be in the pudding as to whether they've ramped the interest rate swap component of the banks who actually enact U.S. monetary policy at the behest of the U.S. Treasury and Federal Reserve. The proof will be in the pudding, and we'll see it in a couple months. And just based on the fact that since late December to now, the 10-year bond has crashed by 40 points, and I suspect it's going to continue crashing down. That will be, in my view anyway, that will be the proof in the pudding that this is indeed the case.
And
so
you have a lot of experience, 15 years experience in international derivative market. You have a deep experience. I didn't put that in your introduction, but from your, you will be able to do some analysis on this, when you get the Comptroller of the Currency report in the future. But doesn't adding this tool, isn't this just more risk and leverage into the system? Right?
Yeah, of course
it make it worse? So on the outset, oh, wow, interest rates are going down. But on the back, on the outward look, you think, wow, interest rates are going down. The 10-year, look at the 10-year, 2.66, last week. But in the back end, if you look behind the curtain, you say, oh, my gosh, look at all the risk. Isn't that what you should be thinking? That the system is getting riskier and riskier and nothing's getting better?
Well, the real risk is going to be that people who thought rates were going up are going to be wrong positioned for a rate decline. So you see, as is so often the case, people doing the rigging usually make money, and it's people who are like the innocent Joes who are just trying to do the best they can with the best information available. They're the guys that are getting hurt all the time. Like 5 years ago when rates were substantially higher, and we had a financial crisis, most people I know and most of the mainstream said, well, that'll make rates go higher. I said, no, the rates are going to go down. And that's basically 5-6 years ago is when I first identified how they were driving rates down with using the interest rate derivatives. And lo and behold, rates crashed. They went down. And that was contra what most people thought would be the case. Now, we were sold a bill of goods by the establishment. We were told that this was all a flight to quality. Well, it wasn't a flight to quality, Greg. And the reason we know it wasn't a flight to quality is because when rates started to crash during the financial crisis back in 2007, 2008, the U.S. dollar was crashing. The U.S. dollar index was crashing down through critical support, making new lows. Well, you don't have a flight to quality when a currency is breaking, critical points to the downside, and then you see a massive derivative-induced rally in the securities of that currency. The two don't jive. So and you can see by the sheer volume of these credit-dependent instruments that are being strapped on by select banks in an environment where normal banks can't even do an overnight loan. And you look at a certain bank like a J.P. Morgan or a Morgan Stanley growing their derivatives book in a 3-month period when banks can't get an overnight interbank loan done. These guys are growing their derivatives books by 8 and 10 trillion in 3 months. It doesn't work. That's an impossibility. It didn't happen. Not naturally. These were direct interventions. These were the people that run the Keynesian banking complex panicking and trying to make people believe that there's demand for their debt, demand for their bonds, and they invoke whatever they have to try and basically try and stop. See, the crash should have happened a long time ago, Greg. This thing's been propped up so many times, and the question is, and a lot of people might say, well, then they'll continue to do it. But there again, I speak to the Achilles heel. The Achilles heel is something tangible, physical, that you can hold in your hand. And, you can't...
The question is, how long can it go on? And your answer would be?
Well, it's finite. You see, the answer is it's finite.
At some
point,
the amount
of gold in the world is finite. The amount that comes out of the Earth's crust every year is finite. But the amount of paper they're selling is infinite. And those two things don't cross. And at some point that breaks. And so when is the last straw that breaks the camel's back? Well, I've said it before, I'll say it again. Basically, it'll be when China doesn't get their gold. This is all about gold.
Rob Kirby, Kirby Analytics, that's a subscription service. And of course, you with the derivative thing, I wanted to get that in because you have a deep experience of international derivatives, credit swaps, that kind of thing. And you have tell us a little bit about your newsletter that is subscription service that people can get.
Well, you can find me on the web at kirbyanalytics.com. That's it.
And you write insightful articles. You give people this right here in written form.
Yeah, that's the information that I try to convey to my subscribers on a timely basis.
Yes, sir. Well, thank you for basically giving this information to all the people of USA Watchdog. I'm sure you're going to be a big hit. This is a long one, my friend. Good one. Thank you so much for joining us today and enlightening us.
Pleasure being with you, Greg.